Good afternoon, everyone, and welcome to the Fat Profits macro webinar. Patrick Ganley here, along with Angus Geddes. Angus, how are you today?
Yeah, very well, thanks, Patrick.
Yeah, good, and thanks for everybody for joining us today for the presentation. We've got a lot of things that we want to cover off on. Again, Angus and Patrick here. You can see us, and I just got to go through some housekeeping items at the moment. Please remember that any information or recommendations or content that's provided today is on a general advice basis. Before acting on any of the content in this presentation, be sure to consult with your financial advisor before doing so. And a reminder that past performance is no indication of future returns. During the presentation, as always, you'll be able to ask some questions. Type them in where the orange arrow is, and Angus and I will do our best to answer all the questions that you may have. If you cannot hear the presenter today or hear Angus and I, please call the office on 1-300-88-1177, and we'll look to help you tune into the presentation. So without further ado, we're going to get into the presentation. Market update. Angus, it's been an interesting couple weeks. I know this is it's been 2 weeks since you and I have been on, but there's been quite a bit going on in the markets, and I thought we'd start with the S&P 500.
Yeah, you're absolutely right. There's never a dull moment at the moment in the markets, Patrick. So look, I think with the S&P 500, there's a debate around the sustainability of the rally. The valuations, if you look at the S&P 500, have hit that top upper end echelon of the historical band at around 21.5 times. So that has typically marked, a near-term top in the market. What's also interesting is the fact that there's 7 stocks have done most of the heavy lifting this year in terms of the performance. So it's been a very narrow rally. We haven't seen the Russell 2000 follow. We've seen the Dow actually not do as well. So there has been quite a lot of debate over where the market's going. Now, whilst I think the US market has run pretty hard, and we could get a correction at any time, I don't think it's going to be particularly deep or particularly long lasting. The liquidity argument is quite real. There's 6 or 7 trillion tucked away in cash deposits and bank accounts in the US that could be drawn back into the market on any pullback. And I also think these big technical support levels will be very vigorously defended. The first one at 5,000, which would define a 10% correction, that's the obvious one. But it's even more formidable when you go down to, say, 4,800 or even sort of 4,600. So I don't think those levels are going to get taken out. If we did get, in the event that we did get a correction, and that hasn't happened, but it will happen at some point this year. Now, in terms of the near-term catalysts and what I'm looking for, obviously tonight we've got Friday morning US time, we've got the non-farm payrolls. That will give us a window into how well the labour market is going over there. And judging by the weekless jobless claims report and a couple of those other data prints, the JOLTS report, we can see that the labour market over there is fraying. This is exactly what the Federal Reserve wants to see. We know that inflation's been trending down. Morgan Stanley's got a high conviction view that that's going to continue to come off over the next few months, and that there'll be 3 rate cuts by the Fed this year and 100 basis points or 4 rate cuts next year. So look, any downturn in the US market, it'll have to be a growth scare. Now that we're getting very close to the Fed easing, which is normally a tailwind for the market, it'll have to be a growth scare, and about whether that that high PE valuation is sustainable. And I would even also argue that some of those mega cap stocks, which are on 50, 60 times earnings, I think there's a lot of heavy lifting to do there. But if we look out around the world and some of the sectors that we're backing, you know, I think valuations are actually pretty reasonable. You know, I think we'll talk about the ASX 200 in a minute, but I'm upbeat on Australia, on the stock market. I think the UK's looking terrific, and also, you know, finding opportunities, obviously in Japan and Hong Kong dash China. So, look, all in all, we could have a bit of turbulence, but you know, there's some fairly significant support levels, technical support levels, where a lot of that cash and liquidity parked on the sidelines will come in and buy the dip. Secondly, you know, if you lined up all the stock markets around the world, we're only really seeing that extreme valuation come through in those tech AI stocks in the US. And thirdly, you know, valuation around the world is still pretty compelling. And fourthly, you know, we're moving into moving through the inflationary cycle now, where all the central banks are going to ease. I still think that the RBA will be easing potentially later this year, certainly next year. I certainly don't see a rate hike despite that elevated inflation print. So that's all good for markets, and I think, you know, this sets us up, you know, for a decent run into the end of the year, but also into next year, with the proviso that we could see a short-term shakeout, which I believe will be concentrated in America. So that's pretty much the state of play.
Okay, and Angus, you know, we've spoken a lot about the U.S. dollar. What's your thinking here with the U.S. dollar at the moment? Do you think it's going to continue to go down, or where are we heading with this?
Well, look, you know, the technical setup favors the upside, and I've been pretty transparent about that, you know, in my note most of the year. There's no question the technical setup skews to the upside, but I believe the fundamental case is actually the fundamental bearish case for the greenback is fairly significant and could trump the technicals. Why do I think that? Well, you know, number one, we're getting to a point now where the Federal Reserve will begin to cut interest rates, and they will probably cut interest rates at a much faster pace and much more deeply than the rest of the world. Why is that? They had to put them up that much further than the likes of the ECB, the Bank of England, the RBA, because their mortgage market is way less sensitive to interest rates than the rest of the world. You know, and that comes down to the fact that the average American has got access to a 30-year mortgage where they can fix the rate for 30 years. So, you know, the path of monetary policy transmission is not as effective in America. So it stands to reason they will cut much more deeply. That's going to narrow the interest rate differentials that have favored the US now for the last several years, just as we saw the US dollar outperform when they were hiking. I think we're going to see the US dollar underperform. Looking further out, I think, you know, regardless of whether Biden or Trump gets in at the end of the year, arguably if Trump now gets in, I see the polls are favouring him now. We're going to see proliferate fiscal spending. That is not going to slow down. US debt is going to rise, even though the Fed might be cutting and bond rates might fall. Near term, I think interest rates are not going back to where they were. So basically it means that the US is going to have a heightened debt servicing bill for some time. There's less appetite for US bonds than what there once was. We're seeing some countries such as Japan and China actually become sellers, and you know, this in turn is going to lead to capital outflows. So I think, you know, there are a number of things that can really weigh on the greenback, and I think it's a big part of getting the macro, some of our macro economic themes right for this year. You know, it comes down to that US dollar rolling. I'll just finish with a technical comment. you know, we've got that sort of consistent uptrend, you know, which has been tested on multiple occasions since last year by the dollar index. But equally, you know, we've seen these lower reactionary highs as the dollar index sort of coils up within this converging triangle. And, you know, as we move towards September, which is possibly when the Fed will commence with its first cut, JP Morgan actually thinks they'll go in July. I don't think we can rule that out, or early August at the next FOMC meeting. You know, this is going to put downward pressure on the greenback. And, you know, in terms of our thesis and our themes and how we've set our portfolios up, you know, a downside break would be really positive for us because it would put a bit into commodities, it would put a bit into emerging markets. It would also be obviously very bullish for precious metals. So yeah, that's pretty much our base case for the US dollar. But technically, you know, it's got to actually put that break down below 105 on the chart. We've got to see a decent break below that, and then we've got to see those May lows at 104 taken out, which would then start to confirm, you know, a breakdown in that bullish pattern, which has dominated the dollar index for some time now.
Okay, with that in mind, let's touch on gold. I mean, obviously, you still strongly believe that if the US dollar is coming off, it's going to be very good for gold. And you mentioned precious metals, but we'll have a look at the gold chart here at the moment.
Yeah, so look, we saw quite a decent pullback in the gold sector, not just in Australia, but around the world. And I think the way a lot of traders were looking at it is that red dotted line or that neckline was in danger of being breached. And I think, you know, there was a trading view that, you know, gold could take out that 2280 support level and actually push to the downside, which is probably priced into a lot of those gold stocks quite quickly. What we saw yesterday with that moderate downward dynamic in the dollar, it put a real impetus into the gold price, and it broke that near-term downtrend. So that's quite encouraging. Look, you know, things can change day to day, week to week, but you know, it is looking like the potentially that gold correction is over, and we could start seeing a resurgence of upward momentum, which would be great. You know, it'd be good for, you know, the gold sector and the precious metal miners and a lot of those stocks that we've got exposure to, Patrick.
Okay, so you still have some good positions in the wealth management in your portfolios. You still got some good positions in the gold sector at the moment?
We do. We're well positioned across all our portfolios. We're well positioned, and not just in gold, but also in silver and the international. We own a fair bit of that. And in the Global Contrarian Fund, we own quite a lot of silver equity exposure. And you just put this chart up again. You know, we've seen a breakout to the upside. I think the silver chart, silver's not as it's not as overextended above that big historical resistance line of $29 as gold. But nevertheless, so in other words, we're seeing silver catch up to what gold's been doing since the beginning of the year. But so this is more encouraging. We've seen this successful test of that $29 support level. It's building another step above the base. It's respecting that primary uptrend that's been in place since Feb 24, and it's now reasserting to the top side. So very encouraging. Very encouraging. You know, and I think, you know, the price action that we're seeing in the precious metals ties back to that that negative price action we're actually seeing in the dollar. Comes back to dollar weakness, which in turn, you know, seems to be all about anticipation of what the Fed's going to do with interest rates and making those interest rate cuts as we move towards September and into the second half of the year.
Okay. And if we move over to the tech sector, and we got the Nasdaq Golden Dragon Index here, how do you see this all playing out, Angus?
Well, we've had some well-defined breakouts from primary bear markets on the Hang Seng and also the CSI 300 to a certain extent. So they're the main Hong Kong, China benchmarks. This index is basically made up of large Chinese tech stocks that are listed in the United States on the Nasdaq. The traders as ADRs, things like companies like Tencent Holdings, Alibaba, PDD, Baidu, you name it, they make up that index. So we haven't actually seen a confirmed inflection. We haven't seen that, but what was encouraging this week is that bounce off that primary uptrend. We've seen a decent upward dynamic yesterday off that 6,000, converging within a contracting, narrowing range or a triangle formation. So, if the Golden Dragon Index can get above 7, I think that would be very positive for the US, for the China Hong Kong stock market. We're seeing better price action domestically in China and in Hong Kong. In America, they kind of look at that market as uninvestable, even though the Hang Seng is valued as cheaply as it has been in the last 50 years, coinciding major bottoms in 1974 and 1982, I believe. So yeah, a break above 7,000 would be very encouraging and confirm that inflection. And I think that would have broadly very positive implications for mainland Chinese stocks and certainly Hong Kong stocks, which we're focusing on at the moment.
Okay. So if we get back to gold for a minute, we'll look at the Van Eyck Junior Gold Miners ETF here, GDXJ. How do you see this at the moment?
Well, I think this is a textbook inflection, Pat, that's playing out here. We've seen this converging triangle, this primary downtrend in place since the junior gold miners peaked in 2020. It's broken that convincingly this year. Yeah, it's pulled back. We've seen a correction, from 48 down to towards 40, but a nice consolidation, which is what you really want to see. Again, this a typical formation, following a lengthy downtrend. The first step above the base is being established, and I think it won't be long before we see the gold mining, the junior gold mining, the gold miners in this particular ETF, which is made up of global junior gold miners, reassert to the top side and challenge those April-May highs up at 48. So this is really bullish. It's encouraging, and I think all things being equal, for right on the dollar, and we get the gold price right, then we should see much higher levels with this ETF over the next year or so.
Okay, and earlier you touched a little bit on the ASX 200. We'll just move back to Australia at the moment. We got a good chart here on the ASX 200. How do you see the Aussie market at the moment?
Very bullish on the ASX 200. I think the index is doing really well. And we all watch the news, every night. There's a lot of uncertainty around the economy. There's concerns around inflation. There's concerns around the RBA putting in another hike, consumer spending being down, the pubs, restaurants empty, people are tightening their belts. Yet through all of that, we've seen the ASX push above that 7,600, 7,500 resistance level, and it's managed to sustain that on the top side. So I think this is really good. It's taken the ASX 200 the better part of 16 years to sustainably move above that 2007 high. And the market is not expensive by any means, and so I certainly think that we're heading higher over the next year or two. I think we'll be probably quite surprised at how far the ASX 200 extends. It could get to 8.5, 9, even 10,000. Where's the lift coming from? I think it's going to come from the broader market. Our market is not expensive, and I also think it's going to come from the resources. You know, we've got this sort of secular bull market thesis in commodities and precious metals and energy. Australia is really well positioned to benefit from that. Yeah, Australia is one market that I think carries less risk than some of those stocks in America. And you know, and I sort of sleep well at night, sort of knowing that, you know, valuations aren't overextended, and particularly in the resources sector, which I see as providing, you know, decent opportunity, particularly after the pullback that we've seen over the last sort of 6 weeks.
So obviously for the ASX 200 to go up, you're talking about the resources. What do you think about the banks? They'll have to play a part in this as well, don't you think?
Yeah, look, there's a lot of brokers and fund managers are bearish on the banks. Technically, you know, they've all broken out of these extended bear markets that have been in place, these downtrends for the last 10 years. So, you know, I think there's a place for the banks in the portfolio, and I think, you know, they potentially will go higher, particularly as we get closer to the RBA easing rates. We know that interest rates are not going to go back to where they were. So, you know, bank margins are probably going to hold up quite well. We also know that, you know, the housing market hasn't rolled over here, and immigration is going to continue to drive that, whether we like it or not, over the next 5 to 10 years. So, you know, that does place the banks in terms of their bread and butter, in terms of the domestic housing market, in a pretty good spot. So, you know, I think the banks will provide some of the lift, as will some of the industrial companies.
Okay. And you and I had a brief chat this morning. I know we're talking about people tightening their belts, but we got some upbeat retail sales numbers out. They were positive surprise. And I know you and I had a chat about this morning.
Yeah, I was a bit skeptical of that retail sales print. I mean, you know, Go Australia, it was good news that people are still spending at the malls. But I'm still cautious. You know, the higher for longer narrative for the RBA, you know, they're going to have to hold for longer than the US, that's for sure, given where inflation's at. You know, it is beginning to bite. It is beginning to bite. And as is higher accommodation, higher rents, higher mortgage servicing costs, etc., taking a bigger bite out of people's incomes. So, you know, I wouldn't be rushing out to buy the discretionary retailers just at this point. You know, I think, you know, as we get closer to the RBA easing, that's probably when to have a look at it. And I think, you know, I'm just a bit cautious that we don't get some negative numbers coming through in the next few months. So a little bit sanguine about that print this week, Matt.
And thought we'd touch a little bit on energy, oil. Here we got a stock we're going to talk about, which is Santos, listed here on the ASX. And we got the chart here for Santos. How do you see this at the moment, Angus?
Okay, so Santos today is trading up 4.5% at $8, just a little over $8. It's a decent move for Santos. I think this technical setup is really quite bullish. Whilst, you know, Santos is yet to break free from a primary downtrend that's been in place since 2008, I think it's in the making. There's been, you know, speculation in the press about Saudi Aramco and a couple of those really large, you know, energy majors making a bid for Santos, which wouldn't surprise me. You know, it's cheaper to buy energy, oil and gas than it is to go and find it. And if we look at the technicals, you know, we know Santos is well priced, you know, attractively priced compared to, you know, energy pairs overseas. We know that the world's going to need a lot of gas to navigate its way through the energy transition. The other thing is that, in terms of the oil price, it's not falling over either. The world's going to continue to use a lot of oil, maybe not in combustible engines, but in products, for many decades. So what this technical setup to me says is if Santos can really break through that primary downtrend and near-term resistance at around that $8 mark and sustain that, then I think we could see, a decent recovery towards $9, even $10 quite quickly, over the coming year. So there's opportunity there. Santos also pays a fairly attractive dividend.
Okay, I thought since we're on energy, just how you feeling about uranium at the moment?
Good, good. We know that that the world's going to need a lot of power. There's a lot of countries out there where renewables just won't cut it for them. And green energy, nuclear can play a big role in providing some of that green energy. Yes, they're expensive to build, but once they're in place, these power stations run for, nuclear power plant can generate energy for 60, 80 years. They have a very long shelf life, and they're reliable. Look at the French. They're 70% of their power comes from nuclear. A lot of that was built in the 50s and 60s. They've got the cheapest electricity costs in Europe. So I think, for a lot of nations, I'm not saying Australia is in this camp. I don't want to get sidetracked into that side debate. But for a lot of other countries, they've just got no choice but to look at the nuclear option, including America. The other point to make, Patrick, is whatever we think the world is going to need in terms of power consumption in the next 10 years, I think AI is truly going to be transformative. Think about all those data centers, all those new chips and devices, all requiring new power. And I'm not just talking about electrification of motor vehicles and that sort of thing. But the world is going to change, and we're going to probably find that power consumption grows at a much faster rate over the next 10 to 15 years. So I think that's going to underpin, and a lot of countries will be out there hedging their green energy, zero target emission strategies. That they'll be hedging with nuclear. So all of that's got to be reflected in the uranium price, which is the way we're playing it. And I think a lot of those contracts with those nuclear energy utilities, a lot of those run out by 2025, 26, and they'll be sort of forced to roll over at higher prices. They're not too concerned about it anyway, because believe it or not, uranium is actually a very small part of a nuclear reactor's input costs, perhaps like 5 or 10%. So demand's probably going to be relatively inelastic, and as demand goes up, we haven't really seen a huge supply response, and I think that will be reflected in much higher uranium prices down the track.
Okay, and if we touch on another gold stock, one of the stocks that was the darling of the ASX there for a while, Chalice Mines, it's had a bit of a rough trot recently. You can see it on this chart. How do you see Chalice at the moment, Angus?
Look, I'm still cautious. I think the Chalice is still range bound between $1 and $2 until it decisively breaks out above 2. I would just give it the benefit of the doubt. But they've got an interesting deposit which they're continuing to prove up, and I'm sure it will get developed at some stage, but there's a long lead time. It's always good to sort of highlight an explorer, albeit this one has a proven resource and reserve base, because sometimes they do different things to what the gold miners themselves do. Gold miners tend to move up and down with the spot gold price, whereas and the copper miners are the same, whereas the explorers, they're not going to be in production generating cash flow for a while. So, a lot of that will come down to just how bullish the market is. We haven't really seen bullish sentiment return to resources sector, but don't get me wrong. I think there's a bull market coming that will lift that end of the market, but we're just sort of finding a lot of value right now amongst the actual miners themselves, which continue to screen cheap in my view.
Okay, and if we move out of Australia for a minute, we head over to Asia. Here we got the Hang Seng. How do you see this playing out?
I think, again, this is a textbook move. We've seen the pullback from 20,000, the Hang Seng. When we called the bear market, the end of that multi-year bear market earlier this year, the Hang Seng had surged, and from the low point in January to the near-term peak back in sort of May, the index was up 30%. It was one of the best performing markets in the world. What we've seen in the last sort of 6 weeks is just a textbook correction in a very early stage bull market. Bull markets climb a wall of worry. It's particularly so at the onset of a new bull market. And, we've all sort of listened to the headlines and, people worrying about China rolling over and this, that, and the next thing. And, government not using enough stimulus and house prices continuing to slide. I mean, this is all sort of textbook stuff. I think the Hang Seng finds a really good base of support here at around that 17.5 level. It's been doing that above that breakout level. And I think we're going to see a retest of 20,000 not before too long, certainly before the end of the year.
Okay, I thought we'd touch on a few stocks. MGM China in the casino market. How do you see that industry at the moment, and in specifically MGM China?
I think there's a really good opportunity there. We saw MGM China trade at $32 Hong Kong back in the 2014, and then just prior to the pandemic, it was trading 2018, 2019, sort of $16 to $18. So, I think, this stock can get back to those levels quite comfortably. We're seeing gross gaming revenues pick up and certainly get back to where they were before COVID. Technically, MGM China has broken through this primary downtrend. The stock is fundamentally cheap, a little bit like the Hang Seng. It's putting in that sort of first step above the base. So, this technical setup is quite bullish. So I like MGM China. We certainly hold it in our portfolios.
Okay, and we got another stock here we're going to talk about, long for HK 0960, listed in Hong Kong. Quite an interesting chart here.
So I got to disclose, we don't own long form. We haven't bought that for any of our investment portfolios we manage. But I've got to say, it's looking interesting. The real estate sector has really been damaged in a major way over there. But, we're seeing green shoots beginning to move through. We know that the government's basically ordered no more supply, so that inventory overhang of residential apartments can clear. The government's actually also encouraging the local governments to set up funds to absorb a lot of the inventory and establish that as low-cost housing. So I think this is all pretty positive over the medium to longer term. And long for, it's probably one of the best property developers and managers listed in Hong Kong that operates in Hong Kong and in China. We've seen this tumultuous bear market decline by 80%, bottomed at sort of below $9. Again, a little bit like MGM China, it's establishing that first step above the base. All things being equal, we should see, a recovery, at least to sort of $15 over the coming year.
Okay, well, that'll bring us to some of the questions, and got a couple questions here for you, Angus. How are you managing your cash positions at the moment in the managed accounts and the listed funds?
We're running quite low cash positions at the moment, Pat. I think we're seeing a lot of value around the world. Japan's been doing well, but I'm seeing a lot of opportunity in Hong Kong and China. I'm seeing opportunity in the UK and opportunity in Australia. So we're quite happy to be fully invested, particularly as we head into an easing cycle by those central banks. We've seen the Swiss National Bank cut, Bank of Canada's cut. I think the Fed's about to cut, and there'll be other central banks out there joining. We've seen the ECB cut. So, we're heading into an easing cycle. A lot of these stock markets outside America have got pretty compressed valuations, historically cheap. As we sort of discussed before, Hong Kong hasn't been this cheap since 74 and 82, bottom of those big bear markets. Australia's attractively priced. Japan's had a good run, but still attractively priced. The UK's just outright cheap, at around 9 and 10 times. So seeing a lot of value, and I want to be fully invested to take advantage of that.
Okay, a couple questions. Your view on the REITs at the moment and the property sector.
I think property is looking really interesting because a rate tightening cycle was a headwind for real estate. A rate cutting cycle is a tailwind. So I think conditions are about to get a lot more favorable. Now, within the different sectors of the property market, we've seen industrial outperform. That's done really well. We've seen retail underperform. So, that could be about to do a lot better next year. I think commercial office is bottoming as we speak. I think there's, when we see the RBA and central banks around the world start cutting, office is going to make a comeback. And I think the cap rates have probably peaked. So I think if you take a 12, 18-month view on the REITs, I think there's a lot of opportunity in there.
Okay, a couple questions here on the RBA. Are you leaning towards some rate cuts this year? Or do you think they're going to push them into 2025?
Look, I know the inflation number was high. A lot of people are sort of talking about the next move being up. I don't think they're going to hike rates again. Monetary policy is pretty effective in this country at slowing things down, given the property sector and the fact that there's, a lot of people have mortgages that are directly impacted by those rates. So, I don't think the RBA will risk placing that extra proverbial straw on the camel's back. It doesn't want to break the economy. But, having said that, the retail sales number was quite good yesterday. And we have to be, the RBA are going to be data dependent. But, we need to see inflation come down. My personal view is that it will go lower, just as it's been doing overseas. And that we'll see, a bit of slackening in the labour market here, just as we've seen overseas. So that, I wouldn't rule a rate cut out in November. I wouldn't rule it out, but I'd say it's highly probable that we'll get the first one in February next year. I don't think the RBA will leave it much longer than that.
Okay, and as you look out over the next couple of weeks, what key things are you looking at economically, data-wise, and what are you keeping an eye on at the moment?
Well, without question, I think non-farm payrolls going to be pretty important, very important indeed. That will set the narrative really for the next 3 or 4 weeks, heading into the next FOMC meeting, which is at the end of the month. That's a big one to watch. Like if it's another blowout jobs number, like we saw last month, where it came in at, I think consensus was looking for 200,000 new jobs and it printed at 272,000, then, then all bets are off. The bond market's going to sell off if it is a blowout number, and we will see markets recalibrate when the Fed eases and the September narrative probably gets pushed into November. But, if it's an inline number or even a bit below, then that really reinforces the September narrative. I think it's going to be game on in that month. I think they'll be easing no later than September. So that's probably the big piece of data to watch. Close to home in Australia, the CPI numbers, the inflation numbers are very important at the moment in terms of timing on the RBA's next move. So we have to continue to watch those. And then, look, the other data points, it's important just to keep an eye on China. I think, growth over there is actually held together quite well. They're sort of going through a sort of a cyclical low point in terms of their commodity imports. I think that impulse starts to reassert later this year. So watching that as well.
Okay, and just a reminder for everybody, it'll be a bit slow in America probably over the next couple of days. They've got their 4th of July celebration, so the market will be closed over there. So they're all getting into their summer season, so you probably won't see too much action over there at the moment, do you think, Angus?
Well, we probably won't on Friday. It'll be obviously, the market shut tomorrow. It was only did a half day on Wednesday, so volumes were pretty thin, and a lot of people will be taking Friday as a holiday. But I expect a decent reaction. I think it'll be a market moving event. If we see the number come in at sort of 200,000 or lower, beats, comes in below consensus, that triggers a big rally in the bond market. I think we see the dollar come off, precious metals reassert to the top side, commodities follow precious metals, gold, copper, silver, all of those commodities will be higher. But equally, it comes in at 250, 300. We could be in for a bit of volatility.
Okay, and I thought we'd just touch on the fact that you'll be taking a well-deserved break, not next week, but the week after, where you won't be publishing your morning notice regularly.
Yeah, and we do take these publishing breaks. Like typically, in the last year, for example, we would take one in April. I took one in June, and then one in July. One in October. This year, doing a little bit differently, because we're a 4-day instead of 5 days, which I think has generally worked out quite well. I don't think we've, I think it's probably, frankly, Pat, we know that the daily can be quite long, but I don't think, we've lost anything in the way of content by moving to a 4-day format. But yeah, I'll just have those 4 days off. It's just gives me a chance to have a bit of a break and a refresh. It's tough sort of writing and editing, sort of 4,000 to 5,000 words, believe it or not. So well, I'll be back after that week, nice and refreshed.
But even though you're not writing, you're always keeping your eye on the market, so it never sleeps, does it?
That's exactly right. You never really get away from email and text messaging, and the market certainly not. And the caveat is always, if there's a market moving event, something big that happens, I will be updating all our members straight away. If it's breaking news and it's important.
Okay. Well, thanks again, everybody, for joining us today. It was a pleasure having you all on the webinar today. Angus, as always, thanks very much, and we'll say bye for now.
Thanks, Patrick. Bye for now, and thanks to all our members for listening today.